Good morning, everyone. Apologies, we have just had a slight delay in
work out how to do the notes bit.
working out our webinar platform, but we've been told by our expert that we are now live. So thank you for logging in at 10 a.m. this morning. And so you know, this is also on record. We will definitely be sharing this with all our members after the webinar. So I'd like to start by saying, good morning and welcome to the Philanthropy Australia Policy Webinar Common Reporting Standard Update. I'm Sarah Wickham, the new Policy and Research Manager at Philanthropy Australia, and we also have Sarah Davies, the CEO of Philanthropy Australia, joining us this morning and will be helping us field questions. I'd like to begin by acknowledging the traditional owners of the lands that we meet virtually on today, and also pay my respects to the elders past and present. So before we jump into the webinar, just a very small amount of housekeeping. To ensure that you can hear us, please make sure at the bottom of your computer that your sound is not on mute. For those working on their computers at the office every day, sometimes you'll have your sound off. And then secondly, once you do have your sound on, can you make sure that your microphone is on mute, as we have a large number of participants logging in today and a few presenters. The mute button is important to make sure that we're not picking up any loud background music. Then, as you can see in the text in the bottom right-hand side of this webinar, there's a live Q&A panel scrolling. So any questions that come to mind throughout the presentation, please type them down. We'll have the lovely Sarah Davies fielding them, trying to respond to the ones that we can respond to straight away. And any more complex questions, we will park to answer towards the end of the presentation, so the flow of the presentation continues. So yes, we'll keep going. So today we're delighted to have a small panel of expert presenters from both Grant Thornton and the Australian Taxation Office to help us answer these tricky questions around the CRS. We've got Melinda Gibbs and Ricky Herbert, both from the Taxation Office, and our technical experts in Mel from the technical expert in not-for-profit space, and Ricky, our CRS technical expert. And we've got Robert and Eric from Grant Thornton, our tax experts today, that are going to help provide some advice about how the CRS actually directly relates to you as members with your foundation and other giving vehicles. So completed those welcome and introductions. What the webinar will look like today is we'll start with an overview of the Common Reporting Standard from the ATO. We'll then move through to what the effects of the Common Reporting Standard are on you as individuals, and then a little bit of an explanation of what it means to the beneficiaries you support. We'll then go quickly into two different case studies. So these case studies are popular foundational giving vehicles to understand how you would comply to the CRS. Both of those sections will be delivered by Grant Thornton. I'll do a bit of a wrap up with what you need to do as members as next steps. We'll then shut with some questions and conclusion. So please note we won't be having questions from participants voicing through their microphone. We will only be taking questions from the type box in the corner. So I'll hand it over now to Mel and Ricky at the ATO to present an overview of the Common Reporting Standard. Thank you.
Good morning, everyone. It's Ricky Herbert here. I hope you can hear me. I'll just go back quickly through a bit of history as to explain how we got to where we're at today. The United States probably kicked this off in 2014 with their FACTA regime, Foreign Account Tax Compliance Act is what FACTA stands for. And they required financial institutions around the world to report certain information to the IRS in order for the IRS to monitor and manage and ensure the tax obligations of its taxpayers and citizens were met. Now, Australia entered into a intergovernmental agreement with the US so that rather than providing information directly to the IRS, Australian financial institutions instead provide that information to the ATO, and we exchange that with the IRS, and in return we get some information back from the IRS about Australian taxpayer account holding accounts with US financial institutions. As far as not-for-profits or charities were concerned, they didn't have to worry very much about FACTA because the US specifically excluded charitable organisations from being financial institutions, and they also made it easier in another way, in that charitable organisations who hold accounts had simpler processes when opening accounts with their financial institution. Now, the rest of the world looked at this situation and thought, well, that's a great idea. We could very much use information from other countries about our taxpayers and ensure that they're paying the right amount of tax in their home country. So the OECD developed the Common Reporting Standard, which is largely modelled on FATCA. It borrows many of the concepts and some of the IT schema arrangements for reporting. But the CRS is a multilateral regime where participating jurisdictions, and there's more than 100 countries around the world who are participating now, including Australia, participating jurisdictions collect information in their own country from their own financial institutions about account holders who are tax residents of other countries, and then we all get together and exchange that information. And when I say get together, I don't mean physically. I mean we exchange that electronically. Some countries implemented that from 2016, and other countries took a little bit longer, such as Australia, and implemented from 2017. And in fact, we delayed 6 months longer than that. We implemented from the 1st of July last year. Now, in the future, the reporting periods will be calendar years, full calendar years. But for the first year, 2017, it's just a 6-month period of reporting. Now, the Common Reporting Standard, when it was developed, did not have an exclusion in relation to charitable organisations or not-for-profits. So they are potentially caught up in this. This was not actually well understood or appreciated even by tax authorities themselves until relatively late in the piece. I would point to the United Kingdom as an early adopter of the CRS. They adopted from 2016, and they were actually a few months into implementation when they really realised that their charities were caught up in this, and so they went through a process of working out how to deal with that. The ATO fortunately realised before we implemented from 1 July last year and put out some information to help not-for-profits, but I guess still, and that's why we're here today, it's perhaps not been completely well understood across the board that some not-for-profits are potentially caught up in the Common Reporting Standard as reporting financial institutions, and so that's what we're working through today.
Thanks, Ricky. Move on to Grant Thornton now to pick up the next part of the presentation.
Thanks, Sarah. It's Arik Batchelor here, a tax partner with Grant Thornton. Thank you for having us today. It's a pleasure to be here. We're looking forward to having a robust discussion or robust typing from everyone in the right-hand corner there. So I'd like to introduce Robert James, who'll be talking, who's a director in our team. But before doing that, a bit of background on GT. We're a mid-tier firm here, based here in Australia. We are international, but in particular, Robert and Aileen, who's sitting next to me here, and I have a lot of experience working with tax-exempt and not-for-profit entities. So we're hopeful that we'll be able to answer all of your questions today, together with Ricky and together with Melinda, in connection with the Common Reporting Standard. So I'll hand over to Robert now, and he's going to walk you through the discussion, and also you'll notice some slides on your screen which will start moving.
Thank you, Arik. All right, let's see how I go with technology. I'm just going to cycle through the slides until I get to our one. Okay, I'll start with this slide. So as Ricky alluded to earlier, this is potentially a bit of a sleeper issue, especially for those entities in the not-for-profit and charitable institution space. And it's understandable given the FACTA exemptions that have been applied to charitable institutions. And generally with things like this, there are generally carve-outs for charitable institutions. Unfortunately, CRS is a different beast altogether, and there are no carve-outs. So everyone's in the same boat together, charitable institutions or not. Everyone has to go through the process of determining whether the CRS rules apply to them. So in the slide that you should see on your screen now, these rules are quite complicated, but this provides a snapshot of how Australian institutions might be impacted by the CRS rules. So for these purposes, we've referred to the charitable institutions themselves as the grant maker. So every time you see grant maker in the slides, that's what we're referring to. We're referring to the not-for-profit entity or the charitable institution. So if I just jump to the top left-hand box of that slide, the question is, do you derive income from offshore investments? And what this slide is getting at is these types of not-for-profit institutions or charities can have investments not just in Australia but worldwide. And as Ricky pointed out, a lot of countries have agreed to enter into the CRS rules. So there'll be a lot of entities in other jurisdictions disclosing information under the CRS rules in their particular country. So what that means for grant makers in Australia is if they hold investments offshore, then they may have information about those particular accounts reported to the Revenue Authority in the foreign jurisdiction. And also, they might be receiving correspondence from the financial institution asking for certain information or asking for self-certification certificates. So the primary obligation for reporting is with the foreign jurisdiction, but the Australian entities, the grant makers, might start receiving correspondence in that regard. So it's just as an alert, just so if you start seeing that type of correspondence, that you understand why you're receiving it. And to help out the financial institution, just try and respond to their requests in a reasonable fashion. So I'll just jump to the top right-hand corner box now, and this is probably the big focus area of today's presentation. So grant makers don't just support needy people or needy organisations in Australia. There are a lot of grant makers in Australia who support global efforts, and they can donate money or make grants or pay distributions to foreign people directly or other organisations in foreign jurisdictions. So under that type of scenario, then you could be in the gun of the CRS rules. So if you have any of those types of arrangements, or you could have any of those types of arrangements, please listen carefully, and we'll run through some case studies as well. But in a prima facie situation, you are the type of entities that need to be doing stuff under the CRS rules. We'll also go through a timeline as to what period we're talking about in terms of reporting and when we need to comply with the rules by. And just the bottom two slides are, one, if you purely hold investments in Australia, then there should be no reporting on your behalf to the Australian Taxation Office. And if you purely have resident beneficiaries, again, prima facie, the CRS rules shouldn't apply to you. So if we can just jump to the next slide, Sarah. Oh, I can do it. All right. So grant makers, whether you believe you're caught by the CRS rules or not, you have to go through a process called a due diligence to confirm or otherwise whether you're impacted by the CRS rules. Because there might be some arrangement that you're not aware of, so you have to be diligent in your processes to identify any cases of identifying accounts that you need to report. If, as a result of following those due diligence procedures, you identify what I'll refer to as reportable accounts, then there's specific information you have to collect in relation to those reportable accounts, and then you have to report that information to the tax office. And there is a specific format that that information has to be reported in. And we'll get to that in the subsequent slides. Again, if your organisation is a beneficiary, so it's receiving distributions, especially from non-resident entities, then the foreign financial institution or charity will have to report information on your behalf. But if they don't have the information, then they're going to reach out to you. So to help them out, you should respond with the information they require. And if they request a self-certification process to be followed, then please do that as well, just to help out your fellow charities and grant makers in other jurisdictions. So probably the best way to conceptualize how these rules work is to go through a case study. And just keeping in mind that we will have a Q&A section at the end. So please log your questions as we go along and we can attend to them at the end of the presentation. But with this particular case study, this is a very common entity structure in the charitable institution space. So you'll see at the center we have the grant making foundation, which for all intents and purposes is a trust. And in those facts, you'll see that it's receiving 80% of its income from interest, dividends, and trust distributions from 1 January 2015 to 31 December 17. So there's some particular aspects in that fact pattern that are important to make note of. So in identifying whether the CRS rules apply to you, you have to identify whether your organisation is a financial institution for CRS purposes. Now, this isn't your typical definition of financial institution of essentially banks or credit unions. This definition depends on the makeup of an entity's income streams. So, if a grant maker derives 50% or more of its income from financial investments, then it will be considered a financial institution for CRS rules. So, and for the period we're talking at, in working out that proportion, you look at a 3-year period. So you just can't look at the latest financial year and see that you're below the 50% threshold. You have to take into account the last three years and do the calculation on that basis. If you are, so with financial investments, that's typically interest income, dividend income, or trust distributions. So if you have managed investments and you're getting distributions from that, then that would be considered an income stream from a financial investment. So you have to add up all those types of income and divide it by an entity's total income for that 3-year period. And if you are above that 50% threshold, then you have to go to the next question as to whether some of the entity's investments are managed by an arm's length external party. If the answer to both of those questions are yes, then you will be considered a financial institution for CRS purposes. And yeah, so the technical term for the financial institution under CRS is a CRS reporting financial institution. And once you do some research, you'll see that term coming up a lot of times. And there's 2 parts to determining whether you are a CRS reporting financial institution. I just went through part 1, so that's the income threshold and whether your financial investments or some of your financial investments are managed by an external manager. The other part, which I don't think will generally apply to grant makers, but I'll go through it just quickly, is if you conduct an investing, reinvesting, or trading business, and if 50% or more of your gross income over the last 3 years was derived from those activities, then you'll also be captured as a CRS reporting financial institution. But for today's purposes, we're just focusing on part 1, and that's the makeup of the income stream of the grant maker and whether those investments or some of those investments are managed by an external third-party investment manager. So under these facts, then we are prima facie a CRS reporting financial institution. And you'll see in the fact that it says the GMF has tax-exempt status. That doesn't matter. There's no carve-outs under these rules for tax-exempt entities. So you can't rely on that to argue against these rules applying. You have to go through the process, and if you are a CRS reporting financial institution, then we'll have to make sure you comply with the CRS rules. As you'll see under step 1, we made the conclusion that GMF is an RFI because of 50% or more of its income being derived by financial investments, and also its financial investments are being managed externally. So then we have to go to step 2, and that is whether the GMF has any account holders. So there is a particular technical definition of account holders for CRS purposes. For present purposes, in a trust situation, any beneficiary of the trust will be an account holder for CRS purposes. And generally, any distributions to people or any entities that receive distributions from the grant maker will be considered beneficiaries under these rules. So a trust will make distributions every year, so it's going to have account holders. So then you have to go to step 3, and that is the grant maker has to undertake due diligence procedures. And the purposes of those due diligence procedures is to identify reportable accounts and reportable account holders. Now, again, there's a lot of commentary and a lot of rules and a lot of technical aspects to these rules, but as a general statement, as a rule of thumb, if any of those beneficiaries are non-residents, then they are going to be reportable account holders. So once you identify these reportable accounts and reportable account holders, you have to collect the requisite information, and the types of information that need to be captured is the recipient's name and identifying details. So it could be a tax registration number or Australian business number in an Australian example. Have to report account numbers of the reportable accounts, the values of the accounts, and details to be able to identify those reportable persons. Again, the grant maker is probably going to have some of those details, but not necessarily all. So it's prudent to, as part of these due diligence procedures, not to just to identify reportable accounts, but it's to identify what information can be generated in respect of those accounts from existing records. And then step 4 is once you've gone through the due diligence procedures and captured all the information, the grant maker or the GMF will need to report that information. And the first report is due on 31 July 2018, and that is for a 6-month period ended 1 July 17 to 31 December 17. So those aren't made up dates for the purposes of this case study, they are real dates. So not to scare you, but the first report for CRS purposes is due by 31 July 2018, which is just over a month away. So hopefully you've been doing some steps under the CRS rules already. If not, then reach out to your advisor and start getting processes in place to make sure you can comply. And clearly, we're here to help you. PA Philanthropy Australia is there to help you. So if you need help, please pick up the phone to Arik or myself, and we'll be pleased to provide any assistance that you require. So I've covered a lot of territory with case study 1. And I see some questions coming through.
Robert, can we just, sorry, it's just Philanthropy Australia. Yep, can we just pause for a minute? Thank you, that was incredible. We've just got a few questions that have come through. So Sarah Davies is going to ask them and hoping that you guys can respond before we move to case study 2.
So just a couple of quick questions from our members. So Daniel and Kathy have asked whether income includes realised and or unrealised gains from investments.
So that's a very good question.
And can I just say, we're doing this because Daniel raised the question with us in the first place. So I just want to acknowledge Daniel. Thank you, sir.
Sorry, it's Ricky here. I'm not trying to help out Robert. The concept of income for CRS purposes is not defined. It's not a defined word or term. And we wouldn't be going necessarily to what income means under our tax laws either. I think income for CRS purposes takes its ordinary meaning and probably means its accounting meaning. So whether realised gains or unrealised gains are income for a particular entity or financial institution, I think would probably depend on whether that financial institution itself considered it as being income. And that goes to the activities, probably the investment activities of the particular entity concerned. So if the entity is frequently trading in financial assets in a business-like manner, I expect it probably would account for at least realised gains as income. By way of contrast, though, if the entity is by and large just holding investments long-term, passively, and from time to time realises some of those investments, it's probably not recognising those gains as income, and so it wouldn't be income for CRS purposes. So yeah, I mean, the short answer is, how are you accounting for it?
Thanks. It reminds me of the conversations that we used to have when the distribution requirements were 80% of income generated. I think we're going back to those conversations about how you classify income. There's another question here from David, just checking if the external investment manager doesn't have discretion but is acting on a very clear set of instructions from the grant making entity, does that make any difference?
The short answer is it can make a difference. So to be captured, the financial manager has to have a certain level of discretion over the investments it makes. If it's just purely acting on instructions from the grant maker, then that might not be considered an external investment manager.
Oh, that's interesting. Okay, good.
And could I add another point there, Sarah, just on the earlier question from Daniel? When it comes to income, and Ricky, your comments, I would be interested in the ATO's view here. Quite often, not-for-profits will pick up unrealised gains in their P&L as income, but clearly, if for tax purposes, you wouldn't be assessed on unrealised income. So would it be the ATO's view that that would have to come into the calculation of that 50% test?
Yes, I think so. And I know that might seem a bit strange in that we're looking at income for tax purposes in one way on our domestic tax laws, but the income is having a different meaning for CRS purposes. That's just a reflection of the fact that the CRS is an international regime where we need to be consistent with international understanding of what the terms mean.
So to Kathy's question then on donations, which are often included in income as well in a not-for-profit set of accounts, would you be including that therefore as well as income?
Yes.
Yep.
If that's the way the entity is accounting for it, and I imagine they usually would,
Yep.
it would be considered income. But of course, as I think Robert had said, or one of the slides says, it's not income from financial assets. So that it's in the denominator of the calculation, but not in the numerator of the fraction looking to 50%.
Sure, and donations, but there's some ATO guidance, I think it's on your website, Ricky, that does include donations in income. So just wanted to clarify that point with you.
Yes, absolutely. So probably best to give an example. If the income of the institution is $1,000 for the year, which is made up of $800 in donations and $200 in interest and dividends, the total income is $1,000, as I said. in terms of working out whether you reach the 50% threshold, only $200 or 20% of the total has come from income from financial assets, and so the 50% threshold is not met.
So a capital gain, though, would clearly in that example be brought in, because a capital gain on a disposal of an investment would be income from a financial asset.
If that's how the entity is accounting for it, in accordance with accounting standards, then yes, I believe so.
Okay, Eric, we've just got a few questions from members, if I can jump to that quickly.
Sarah, you're just echoing there. Is it possible to just to step back from that speaker or microphone?
Yep, we'll try. Just another question from David. What if the grant making fund is not actually a trust, but it's a corporation or a company limited by guarantee? Does that make any difference?
Again, the short answer is yes, it does make a difference. So it makes a difference in identifying account holders of the grant maker. So we've just touched on trust entities at the moment. So shareholders of companies will also be account holders for CRS purposes. The interesting thing is with companies limited by guarantee, by definition, they don't have shareholders. So they won't have account holders under the shareholder route, but there are also account holders that hold debt interests. So if the grant maker has borrowed money from a particular institution and is paying interest on that loan, then the lender will be an account holder, and depending on where that account holder resides, then they might have to do some reporting in relation to that account to the tax office.
And so to extend Robert's point, what this requires, therefore, is if you are a not-for-profit or charity tax-exempt entity that is a company limited by guarantee, you will need to look at your constitution to see whether you actually have shareholders or members. So often there are companies limited by guarantee that have these members, and there's typically not a huge amount of members in there, and it might actually be that the member is another not-for-profit. But it is important as part of your diligence procedures here for the first year of CRS to make sure that if you are in a company limited by guarantee, that by definition you don't have any shareholders, as Robert's just been talking about.
And it would also be good to just hear Ricky's views on this point. Ricky, do you have anything to add?
No, I agree with what's been said. There's absolutely a difference, a big difference between companies and trusts here, and in the case of companies of whatever form, the only account holders are shareholders if they have them, and debt interest holders if they have those.
Thanks very much. I just want to move on to a couple of other questions, please. Judith would like to know what a non-resident beneficiary is. So are all Item 1 DGRs considered to be Australian resident beneficiaries, even if they might have projects and programs overseas?
So,
Mel here, I can answer.
Yeah, go Mel.
From a tax office perspective, we would say yes, because for a deductible gift recipient to be endorsed by us, they need to meet that in Australia requirement, which is that they are established and operated in Australia.
Good. So that is, my simple brain said that's the first simple thing that I've understood. The answer is yes, if you're an Item 1 DGR, you're considered resident beneficiary. Okay, next question. John McLeod. G'day, John. Actually, John asked the same question, so that's all right. And then question from Glenn. Investing in an exchange-traded fund, unit trust or similar vehicle will not be considered being, quote, managed by the exchange-traded fund, unit trust
or any comments on that from
Yep. So you just look at the account itself, and this would just be an exchange-traded fund. So my view would be that that's just a particular investment, and I don't think there's any discretion in how that exchange-traded fund invests its funds to track a particular index, which tells me there's no discretion. It's not a set of rules that it needs to abide by. So my gut feel is that shouldn't be considered an external management of investment, of a financial investment.
It's Rick again. I agree with that. I support that. I believe that's correct. When we're talking about management, we really need to be looking for active management, decision-making, discretion over what sort of investments are being made. Now, the decision in the sort of scenario where an entity has invested in an exchange-traded fund, the decision there was made by the entity that put their money into that fund in the first place.
That's right.
Great. Well, there doesn't look like there's any other questions at this point, so we might move on to the next case study, Robert.
Sounds good. And they've been very good questions, so thank you, everyone. So case study 2, hopefully this is a nicer example. So we have, in this example, we have a private ancillary fund, which we're calling a PAF for short. And again, that is a trust for these purposes. And if we just move to the facts underpinning that diagram, you'll see that only 15% of the PAF income is being derived from interest, dividends, and trust distributions, i.e. from financial investments. And that 15% is a lot lower than the 50% threshold. So prima facie, it's not going to be a CRS reporting financial institution. And I'll move on to the other steps just as a matter of course. But on this point, this could be the example where the PAF is in the startup phase, so it's trying to be established. So it's just receiving a lot of donations over this 3-year period in order to get it up to the size and scale that it requires to make a difference. And the point I'm making is the income split can change over the life of entities, especially these private ancillary funds. So let's just say in year 4 it becomes established and it's made a lot of investments, and because it's established, the donations have essentially dried up. So it can quickly shift to donation or gift income going to 15% and income from financial investments going to 85%, and that can happen quite quickly. And if it does change like that, then the PAF will be considered a CRS reporting financial institution, and we'll have to make sure it complies with the rules. So, gone through step 1 in a bit of detail. So the remaining steps are just for completeness and just to take into account if the income split does flip, so 50% or more of the PAF's income is being derived from financial investments. If it does go over that 50% threshold, then the PAF will have to identify if it has account holders for CRS purposes. Again, beneficiaries of trust will be account holders. So the PAF will have to identify all the entities it's made distributions to. And they will do that as part of its step 3 due diligence procedures. And in identifying where it's made all its distributions, they'll have to determine whether any of those distributions have been made to foreign entities. And if some of those distributions have been made to foreign entities, then it's likely to have reportable accounts for CRS purposes. Again, it'll have to capture information in respect of those accounts, and then it'll have to report that information as part of step 4. So just to go back to the 50% threshold, just for completeness, you can be over the 50% threshold, but you still need that external management of the financial investments to fall within the rules. If the PAF is controlling all its own investments, then it should fall outside of the CRS rules. But I just make the point that you can't just look at these rules once and forget about them. If they don't apply in the first instance, you have to continually review them at least on an annual basis to see if you can potentially be captured. Because if you're captured, then a lot of information does need to be captured, and it is quite difficult and cumbersome to potentially capture all the information you need to under these rules.
And just to add to Robert's points there as well on the ATO, would like us to remind everyone that just because you're not a reporting financial institution under the CRS rules, it doesn't mean your obligations stop there. In addition to having to check each year, you may then receive a request from a non-resident which has, in a circumstance where it's provided the PAF with a donation, where you might be required to send some information back to the non-resident about the fund itself and self-certification. So there's two streams here. One is clearly looking at your own position and understanding that and complying with the law. And then the second one would be, don't forget you still might get a request to provide information back to another country which has these common reporting standards as well.
Thanks, guys. I've got a few more questions here. And this might be Mel again. David asks, what is a foreign charitable institution?
Go, Mel, sorry.
Oh, no, you go.
I know, I'm happy to defer to you on this one, Mel.
I just, from an ATO perspective, charities, in order to access things like income tax exemption and Commonwealth tax concessions, they have to meet an in Australia requirement. So charities that are in Australia and based here, they're endorsed by us. All kind of non-resident ones aren't able to access the Commonwealth tax concessions that Australian charities do. So I don't know whether that provides that distinction for you.
Could you give us an example of a foreign charitable institution, maybe?
Well, you might have, well, there are a lot of foreign charities, like I see an example like World Vision, where they'll actually have branches that are set up in various locations around the globe. So they may have actually set up an Australian resident entity to deal with their tax affairs or their operations here in Australia. I'm finding it really difficult to find an example of one that sits completely outside of Australia that, you know, we wouldn't recognise as a resident. But then a lot of charitable trusts may distribute funds to foreign charitable entities, so entities operating in a very local basis in foreign jurisdictions. So they might be, you know, foreign aid and things like that are actually distributing money to local charities in other countries.
So my understanding is that if a fund is any kind of income tax exempt fund, regardless of its DGR requirements, it still can only make grants for charitable purposes. So does that exclude any non-resident overseas charity from receiving a grant from an income tax exempt fund?
No, it doesn't.
I think the issue is you've got to look at the constitution, Sarah, of an object of that entity. So if an Australian not-for-profit, and Mel, you please jump in as well, but if an Australian not-for-profit has got its charitable status or tax-exempt, self-assessed tax-exempt status, it's doing so in accordance with the way it's been set up in the constitution, So that's the first step. So if you're making those payments to a non-resident entity, be it a charity or for a study grant or whatever the case may be, step one is that in accordance with our constitution? And then step two will be, as Mel has already identified, you've got to get that charitable status, you've got to pass the In Australia test. And once you've passed that test, where you then send your money overseas, provided you've shared that information with the tax office before you've done it, and they've assessed you as a charitable institution based on that, it shouldn't prevent you from then sending money overseas, because you're doing everything in accordance with A, the Constitution, and B, how the tax office has assessed you.
Okay, thank you. I might just move on. Tom has asked just a question of clarification. If the investment income is greater than 50% of all income, but all of that investment income comes from Australian investments only, is there still a need to report?
Yes, there is.
So the answer, yes. Tom, is that one? And then Daniel.
So just to clarify, you'd have to go to the next step of identifying account holders to identify if you have any reportable account holders.
Yeah. Okay, great, thank you. And then Daniel's question, which I think is a really good one, but may not be able to be answered in 5 minutes, 5 sentences or less, because I think it goes to the nub of all of this. How come the ACNC isn't able to share its AIS reporting showing the list of distribution recipients? So,
could you say that again, Sarah? Just sort of I missed a little bit of that. Could you ask that again?
yeah, so Daniel just said, how come the ACNC can't just share all the AIS statements that everybody puts in anyway, that shows the list of distributions from funds as the account holders? So
yeah, that's a question for Ricky and Mel.
Yes.
Hi, it's Mel here, and I think maybe the very simple answer is that there is not uniform reporting for all charities. So different sized charities report different things to the ACNC, and I just don't think that was considered as part of this reporting regime. It might be something moving forward.
All right, thanks, Mel. Are we happy to move on from case study 2 now? Yeah. I'll just pick up, thank you, I'll pick up from here. So in relation to the timeline for Philanthropy Australia members, it's been quite clear that the process of the CRS came into fruition 1st of July last year, and we've got until the 31st of July this year to complete that due diligence process we have outlined and to lodge that first report with the ATO. And that first period is from 1 July 2017 to 31 December 2017. And then, as you've seen, the next step will be on 30 September 2019 for that data exchange to occur across the CRS. So please be aware of those timelines. Before we get to more deeper questions or open the floor to more questions, just to reiterate the next steps, we will be polishing this recording and sending out to everyone that's participated and all Philanthropy Australia members. So you can download that documentation, the webinar recording, along with the hopefully easy form that we have developed for Philanthropy Australia members to provide to their beneficiaries, the not-for-profits, to help you with that self-certification process, to make that as easy as possible. And we also suggest, obviously, given this is a new piece of legislation, to seek your own specialist advice if you do have some, or alternatively, obviously, shout out to Philanthropy Australia or Grant Thornton for more questions. So we might again go back and open to the floor any more questions, and we do have Daniel asking, what is the risk or penalty of errors or non-disclosure under the CRS requirements? The ATO, do you guys want to answer that?
Sure, I'll be the bad guy here. there are penalties involved with the CRS. There's a penalty for not collecting self-certifications from account holders, and that's around $210 at the moment per instance. There are the standard failure to lodge penalties, same as not lodging tax returns or other things that you might need to lodge with us. Again, $210 and upwards, and also depending on how long the failure to lodge is late. That's per statement, so per reportable account, and you know, the amount could mount up there. There are other penalties as well, which are probably not so likely to be charged, but could apply, such as false lodging statements about reportable accounts that are false or misleading. Yes, I think they're the main ones that reporting financial institutions need to be concerned about.
Ricky, can I add to that as well? During the budget in May, the government announced changes to the significant global entities rules, which could bring in trusts, and it was silent on whether or not that would apply to not-for-profit organisations. But if we use World Vision as an example, the very, very large international charities could potentially come under those SGE rules that are being proposed, which would mean that penalties could be significantly higher than what you've mentioned, which could be as high as $500,000 for non-lodgement or late lodgement of compliance obligations.
Indeed, that's right, Eric. Now, having been the bad guy and mentioning penalties, I'll now try to soften that by saying that as for any penalties that our law may prima facie apply, the ATO does have remission powers, so we will always look at the circumstances of, you know, how did the non-compliance occur, was there reasonable care, those sorts of things, and so penalties can be remitted depending on the circumstances.
Thank you. I might just jump in with a couple of questions, please. Judith would like to know, there's nothing to report. I'm sorry, I know I'm being echoed here. So if there's nothing to report, is it right that we don't have to file a nil report?
That's correct. If you have done all your due diligence, or any due diligence that is required, and you've found that you don't have any account holders that are reportable, so no foreign tax resident account holders, you don't need to report, and you don't need to lodge a nil report either. However, we do encourage financial institutions to lodge a nil report if they're able. There's no consequences for not doing so, but if you do, that's just helpful to us because it tells us that yes, we know we're a reporting financial institution, and it's just that we've got no accounts to report. That can be done relatively. Sorry?
Sorry, I was going to say, however, do you still have to self-assess?
Self-assess in terms of whether you're a reporting financial institution? Or?
So do you, if you think you're, you get caught up in this because you meet the income threshold, still have to go to all your grant beneficiaries and get them to tell you or confirm their status?
Absolutely, yes, absolutely.
But you still have to self-assess, even if there is then no report.
Absolutely, yes. So those steps that Robert laid out need to be followed in order. You know, step one, am I a reporting financial institution? And if so, step two, carry out your due diligence. and step 3, if you've found any foreign tax resident account holders, report them.
Great. So I've got a question here from Wayne. When completing the self-certification, what's the difference between an active non-financial entity that is not a financial institution and a passive non-financial entity?
Good question. NFE, by the way, stands for non-financial entity, or another way of putting it broadly is an entity that's not a financial institution. So for CRS purposes, by and large, entities are split into two groups. Financial institutions on the one hand and NFEs on the other. NFEs are further divided into either active or passive. Being an active whether you're an active NFE can get a bit complicated. So I'm just going to start with the simple rule. The simple rule is that generally active means carrying on a business or active activities. I know that's a bit of a active activities doesn't make sense. A passive NFE is an entity that is most likely just holding passive assets passively, investments perhaps, not really doing anything much other than that. Now the good news for charities at least is that for both FACTA and the CRS. For CRS, charities, those engaged in educational, social welfare, those sorts of things, they are deemed to be active NFEs. And so if you get one of those self-certification forms and you're a charitable organisation, you can tick the box saying you're an active NFE, which will make the rest of the self-certification form a lot easier to complete.
So if there aren't any other questions, we might call it to a close now as it's 11 a.m. So Philanthropy Australia would like to thank our expert presenters for their time today, along with the work they did to lead up to this webinar. Philanthropy doesn't succeed without intelligent and dedicated individuals like yourselves and the organisations you represent, so thank you. And also a big thank you to the Philanthropy Australia members that joined us today, and we hope that you found this webinar helpful.